Welcome! If you are looking for a comprehensive video to review Harmonized Sales Tax or HST, you have come to the right place. By the end of this video, I hope you'll all have a solid understanding of what sales tax is and how to apply it in accounting practices. To start, what are sales taxes? They are taxes obtained and generated from the sales of goods and services to be remitted to the government. Remittance is the process most businesses must do on a regular basis, where they send a sum of money to the government. The government decides the frequency of remittance, which is usually monthly, quarterly, or annually, depending on how much revenue the company makes. In order to know how much sales tax should be applied for a certain merchandise or service, we use a rate that varies from province to province, based on the price it is sold for. Here in Ontario, our HST is 13%. As a consumer, we are very familiar with this concept. For example, if we purchase art supplies for $10, we end up paying $11.30 due to the extra 13% HST. For a brief history lesson, Goods and Services Taxes, or GST, was introduced in Canada in 1991. Businesses in most provinces were charged both GST and Provincial Sales Tax, or PST. In 1997, HST was introduced to unify the two taxes into a single value-added tax, hence the name Harmonized. Ontario joined in 2010, and the 8% PST and 5% GST combined to a single 13% sales tax. Moving on, there are 4 key taxation principles to keep in mind that help you understand the accounting required. 1. Tax dollars are charged to a buyer of a good or service. 2. Tax dollars are to be collected by the seller. 3. Tax dollars rightfully belong to the government. And 4. Tax dollars are sent to the government by the seller at an appointed time. Regarding the last principle, businesses who make more than $30,000 annually must register with the government, who will assign them a number and how often they must remit. Usually, the larger the business, the more frequent the remittances. There are many regulations and exceptions, as sales taxes can be quite complicated, but for now, learning what to do when HST applies is sufficient. Furthermore, there are 2 different types of sales tax: retail sales tax and value-added sales tax. The difference between the two is that for the former, the government waits until the final consumer of goods purchases the product before charging tax. On the other hand, value-added sales tax is taxed at each stage of manufacturing and delivering. For example, miners may sell raw diamonds to a manufacturer to cut, examine, and polish. An extra 13% is added onto the cost to account for HST. Then, the manufacturer will sell the diamonds to the jewelry maker to assemble the diamond ring. They'll charge the jewelry maker 13% tax as well. Finally, the jewelry maker will sell it to the consumer, who will pay the 13% tax. The previous stages, which are the manufacturer and the jewelry maker, are entitled to recovering the HST they paid. Hence, in the end, the government will receive the same amount of money. The only difference is the process. In this case, I will focus on value-added sales tax, as it is the one used in Ontario. To understand how to apply HST into accounting, it is important to know the role of the purchaser and the role of the seller. The role of the purchaser is simple. They only need to account for the price of the product with the added tax. However, the role of the seller is a bit more complex. They must calculate the 13% and add it to the original price of the good. After collecting it from the customer, they will place that 13% into a liability account called HST payable. This is done because the amount collected belongs to the government and the seller owes it to them. So the last step is to periodically remit the accumulated sales tax to the government. When recording transactions with HST, the company has to do the work. There are 2 pertinent accounts: HST payable and HST recoverable. The former exists to help the business keep track of how much tax they need to remit, while the latter exists to help the business keep track of how much they can recover. The reason being is that businesses are exempt from paying HST for purchases for business purposes, so the HST they pay can be refunded. Note that non-business entities cannot recover HST. HST payable is a liability account and normally has a credit balance, as it is an amount the business owes. Since HST recoverable has an opposite effect and counters that of HST payable, it is considered a contra liability, meaning it is categorized as liabilities but normally has a debit balance. This process makes sense, as businesses are allowed to deduct HST recoverable from HST payable for remittance to obtain the total amount of HST owed. It will not be very cost or time efficient if the government and the company sends checks to each other. Now, let's learn how to journalize transactions with HST, starting with purchases. Let's say a company buys a printer from Staples for $500 plus tax on account. As usual, you'll debit the appropriate asset account with this amount. Then, calculate 13% of it, or the HST rate, to obtain $65. Debit this value in the HST recoverable account. Remember, the HST recoverable account is used because the company buys a printer for business use and is therefore exempt from paying HST. It is not Staples' job, however, to decide if this purchase qualifies for the exemption or not. Thus, the company has to pay HST to Staples and later recover the amount back from the government. Next, credit accounts payable with the sum of the printer and HST, since he owes $565 in total to Staples. After you add the description, this is how the completed journal entry should look like. Next, how do you journalize a sale? Let's say you performed a lawn mowing service for $10 plus tax for cash. First, calculate 13% of it and add it to $10 to obtain the amount you receive from your client. Hence, you'll first debit cash with $11.30. Then you credit revenue with $10. Credit the remaining $1.30 in HST payable as you did not earn it and it rightfully belongs to the government. In my above examples, I calculated the extra HST. However, what happens if you encounter a transaction where HST is already included? Using the previous printer example, if the given $500 already includes HST, you have to calculate for the original cost of the good and separate it from its HST. Divide $500 by 113% or 1.13 to do so. You obtain approximately $442.48, which is the cost of the printer. Then subtract $442.48 from $500 for the amount of HST, which is $57.42. Debit the cost of the printer in the asset account. Then debit the amount of HST in HST recoverable. Finally, credit accounts payable with a total of $500. As you can see, this is the same concept as the previous examples, but with different calculations and values. To review, if you are purchasing something, debit asset or expense, debit HST recoverable, and credit cash or accounts payable. If you are selling something, debit cash or accounts receivable, credit revenue, and credit HST payable. Now, how do you record remittance? Recall that it is when businesses calculate the HST owed for the month and send it to the Canada Revenue Agency. This process usually occurs on the 15th of the next month. Here's an example. If HST payable is greater than HST recoverable, you debit HST payable, credit HST recoverable, and credit cash, with the remaining amount owed. Crediting cash represents the cash you remit. If the amount of HST recoverable exceeds HST payable, you do not need to remit, hence no cash needs to be credited. The remaining balance in the HST recoverable account is usually carried forward to the next month. Alternatively, the business can choose to obtain a tax refund from the government, which will look like this. Finally, on the balance sheet, you calculate the amount of HST owed under liabilities. This calculation will be done on the first column of the 3-column balance sheet. Let's say our total HST payable account adds up to $578 and HST recoverable add up to $264. Subtract the two values and place the balance of $314 in the second column, either directly to the right or in a separate row labeled HST owed. Note that it is not an account but simply the result of a calculation. We're done. I have covered everything you need to know about sales tax, what it is, a brief history, the 4 main taxation principles, the 2 main types, retail sales tax and value-added sales tax, the role of the seller and the purchaser, how to journalize HST, how to journalize remittance, and how to place it on the balance sheet. In conclusion, sales taxes are quite intricate and add a level of complexity to accounting processes. Despite this, I hope you feel more comfortable about this topic, and thank you for watching this video.